Traders are piling into equities at a record pace, very similar to the 2021 blow off top. This is the piece of Forex and stock market news that I want you guys to pay attention to. And in today's video, I'm going to show you 3 markets that are set for explosive upside into the end of the year. And we're also going to have a look at when this bull market rally or blow off top is likely to come to an end. And we're kicking off with this Bloomberg headline: a near $1 trillion ETF rush this year breaks Wall Street records. US ETFs see $913 billion in net inflows, breaking the 2021 high. Flows were powered by bull market and election enthusiasm. This year was already a landmark one for exchange-traded funds, but as of Friday, the ETF universe can add another superlative: biggest annual inflows on record. The insatiable appetite for the investor-friendly wrapper, and don't forget, investor-friendly, it means that retail traders often use ETFs. An all-time high in the number of product launches and a relentless bull market fueled by Donald Trump's presidential victory have helped push total net inflows into US ETFs past $913 billion. That beats 2021's record haul with still one more month to go. So it's important to remember when the article talks about investment friendly, it's talking about the fact that retail traders prefer ETFs because of their liquidity and their low costs. So another way to look at this is retail traders are piling into markets at a record pace since 2021, which was of course when we had a peak in the US stock market and a bear market followed in 2022. Such milestones are a testament to the appeal of the easy to trade and low cost vehicles to traders of all stripes. And if you look at the chart, you can see this is breaking the 2021 record, which was by any definition a blow off top in US equities. So it's important to remember in 2021, we had a re-acceleration of inflation. We saw equities going up, we saw the dollar going up at the same time, and this is exactly what we're currently seeing. And now the data is coming out for ETFs to show that not only are we seeing the same assets performing or outperforming as they were in 2021's kind of blow off top, we're also seeing the inflows breaking that 2021 record. Now, of course, the problem is, just like in 2021, melt-ups take place until they don't, because what happens is when you have higher inflation, you get bond yields pushing higher, and this is actually deflationary. A higher US dollar is deflationary, and all of this eventually catches up with the market and ends up being a negative for US equities. And this has Bloomberg asking with this headline: the Trump trade is still moving markets, but how long can it last? Trump's election win quickly pushed up US stocks, the dollar, and Bitcoin. Now, for those of you who watched the melt up video that I put out just after the election, these are the exact assets highlighted in that video that I said to you are set to gain and gain substantially. And in today's video, I'm going to show you 3 more assets into the back end of this year, which I think have the same explosive upside potential. The article goes on to point out that the Trump trade is set to hang over markets, and this is because of the policy agenda of tariffs, tax cuts, and deregulation driving the big moves, which are, of course, all inflationary policies. So let's go and have a look at the S&P 500 in 2021, when we had these record ETF flows in 2021. What happened towards the end of 2021 and what happened in the following year in 2022? Well, if we pull up the chart of the S&P 500 in the hedge-quantitative trading platform, you can see January the 3rd, 2022, this was when the market peaked. And we went into a bear market all the way through 2022 to October the 10th, 2022. So when we look at this chart, we see the inflationary melt-up that takes place in 2021. We get those record ETF inflows in 2021. Because of the inflation, we see yields going higher and the dollar follows it. And because of these deflationary moves in yields and the dollar, it starts to weigh on equities, and we see the peak and the bear market at the end of 2021 and into 2022. Now, what else did we see in 2021? Right as equities peaked and we started to see inflation not being a positive for equities, but starting to become a concern and actually affecting equities negatively, causing that bear market moving into 2022 and throughout 2022 into October of that year. But if I pull up this chart of natural gas, you can see right at the end of 2021, when we were having these major inflows into ETFs, we saw nat gas bottom, and it rallied all the way through 2022 into August of that year. So what we're seeing here is we're seeing nat gas coming down, and because of this, the inflationary regime that's being traded in 2021 is positive because yes, we are trading inflationary regime and the dollar's going up and equities are going up with it. But overall, some of the main inflation drivers like nat gas are subdued. But as soon as nat gas started to bottom and reverse higher, this scared the market, and this was when the market started to top at the end of 2021 into the bear market of 2022. And if I pull up a chart of nat gas now, this is the first market that I want to show you is setting up for potentially an explosive move, because we now have an inverse head and shoulders in the weekly time horizon just about to break out. And when this thing moves to the upside, it can really, really move. And if I pull up nat gas in the HedgeDash quantitative analytics platform and just turn on the yearly levels, you can see we still have a huge amount of upside into the 4.20 for this year. So we could very easily, especially with the way nat gas moves to the upside, that's why it's called the Widowmaker. You don't want to be shorting nat gas. But when nat gas gets going, it can really move. And we're looking at essentially a move from around $3 to potentially $4 by the end of the year. That is over 33% return in nat gas, potentially by the end of the year, because nat gas can move either to its upper or lower bound. It still has the runway for the remainder of the year. It's barely moved, and that's because it's kind of lack volatility. But what follows a period of low volatility? A period of high volatility. So this market is really setting to break to the upside. And I don't mean next year, I mean it's breaking out right now. And if I pull up this chart of the United States Natural Gas Fund ETF, otherwise known as UNG, ticker UNG, we're setting up for a potential big move to the upside in this ETF as well. Because what's interesting about this setup is UNG as an ETF tracks natural gas, and natural gas has been coming down, coming down, coming down. But look at this. As we've seen nat gas starting to make higher highs and is now breaking out of a major reversal pattern, which is an inverse head and shoulders, which is a bullish reversal pattern, UNG as an ETF has actually been making lower lows. So we've been seeing a divergence where UNG is actually making lower lows, but nat gas is making higher highs. So if nat gas is set to explode, there's a very good chance that this in UNG turns into a bigger double bottom. And again, much like nat gas, you can get quite explosive moves in these kind of commodities and nat gas products. So keep your eye on not just nat gas, but also UNG, because both of these are now setting up for a bigger breakout to the upside. So again, we're seeing nat gas forming a bottom just as we start to see stocks kind of melting up and we start to see retail traders piling in to primarily ETFs again to get those low costs and the liquidity. But we know in 2021, this essentially all ended in tears, and this is going to get to the part where we're going to look at when this near-term rally in stocks is likely to come to an end and how much further we have to potentially trade it to the upside. Now, if we go back to Bloomberg, you can see options traders are already unwinding bullish US stock wagers on rate concerns. Some of the bullish trades put on in the days around the US presidential election are already being unwound as the prospect of slower interest rate cuts, in other words, higher for longer, is essentially another way of looking at that. But either way, this fear around the Federal Reserve not being able to reduce rates quickly has helped to halt the stock market rally. So we're already seeing, and I think there's a little bit more room to the upside left in this, and we're going to look at GME later on in the video, and I'm going to show you why I think GME could have some good upside into the back end of the year. So we're already starting to see some market participants getting concerned, especially if we're going to get a rally in nat gas and we're going to get a reacceleration inflation, that actually interest rates going up or being held higher are going to start to be negative for equities rather than positive, just as we saw inflation in back end of 2021 being positive and then negative as we started 2022. We revisit Bloomberg with the great post-election rally hitting a wall as Powell weighs in. Rate angst sparks worst weekly pan-asset sell-off in 13 months, with Citi saying that the market action is showing investors are starting to feel exhausted. And what's causing the concern for investors? Well, after a post-election risk-taking binge, stock investors sobered up this week as Jerome Powell's go slow message on interest rate cuts called the Trump trade euphoria. And here is a key thing to pay attention to. The article goes on to say, with the world's most important central banker in no hurry to ease monetary policy thanks to a still robust labor market and strong economic data, bond yields once again rose and dragged stocks lower in their wake. So again, this really goes back to what we were saying, which is that it's the fact that interest rates are getting to a point where this is going to become negative for stocks. And although we're seeing stocks rally, traders are already looking for the potential exit. And if we start seeing nat gas really breaking out to the upside and quite quickly, as it tends to do, this is going to really compound the problem and put massive upside pressure on bond yields in the US. And this creates another problem because it creates a downward spiral for bonds. Why? Because if we go back to Bloomberg, you can see Japan and China are now dumping US treasuries. Starting from before Trump won the presidential election, investors from Japan offloaded a record amount of US bonds in 3Q, in other words, the third quarter, with both nations potentially continuing to sell US debt. So what we're seeing here is as inflationary pressures build and they're pushing bond yields higher, the owners or those holding US treasuries are starting to sell them. And if the owners of US treasuries start to dump their bonds, what does that do to the yield? It pushes the yield up even higher. So you get this kind of self-fulfilling prophecy. If we revisit the article, it says two of the world's biggest foreign holders of US government debt offloaded a pile of treasuries in the third quarter as they rallied before the presidential election. Japanese investors, and this is key because they are the largest holder of US debt, and they sold a record $61.9 billion of the securities in the 3 months ending September 30th, with China also offloading $51.3 billion during the same period, which was the second biggest sum on record. So we're seeing inflationary pressures start to push bond yields higher, and as a result, this is causing those who hold US treasuries to start to dump their bonds, and that's pushing yields even higher. Now, if at some point this is going to be negative for equities, and I'm going to show you exactly when I think that will be, who are the beneficiaries of this? Well, that brings us to the next market that I think has quite substantial upside potential, with a major breakout currently taking place. And with this Bloomberg headline, we can see Goldman sees dollar stronger for longer in new tariff regime. Firm updates forecast, expects dollar strength over the next year. Lofty greenback could lead to fresh intervention around the world. The article goes on to say the dollar is entering a new period of strength, fueled by Donald Trump's plans to impose steep tariffs. And Goldman Sachs have now reversed their outlook on the dollar, quoted here as saying, "We no longer expect broad dollar depreciation. The dollar will be stronger for longer." And this brings us on to the next market, which looks like it has some explosive upside, not just technically, but we have the fundamental drivers in place as well. And that's US dollar ZAR. You can see here on the daily time frame, we have this inverse head and shoulders reversal as well. And this is coming at a time, not just when the US dollar is moving higher and bond yields are dragging it higher, but also when we have South African inflation coming out softer than expected. So we have a fundamental divergence here between US inflation and South African inflation, which is bullish fundamentally for the US dollar versus the South African rand. Now, if I zoom out here on the weekly time horizon just to get a better perspective of this Forex pair, and I turn on the annual levels in the Hedge Dash quantitative trading platform, you can see not only do we have roughly about 10% in this pair to the upside to take out the prior high, but we also have plenty of room still left to take out the upper annual bound for this year at the 20.91, roughly 15% upside. It doesn't mean it's going to get there over the back end of this year, but it means that it can. It has the runway to do that should we start to see this moving quickly to the upside. And very much like nat gas, you know, US dollar South African rand is kind of like the nat gas of Forex, along with maybe the US dollar Mexican peso. It's a very volatile currency pair. So this is also potentially setting up for quite an explosive move to the upside into the back end of this year and into 2025. So I've shown you now two charts here which have potential explosive upside in them, and that is nat gas, which is breaking out of a major inverse head and shoulders as we speak. It did that in 2021 just before the US went into a technical recession, not a jobs recession, but a technical recession in 2022, and we had that bear market. And if we're going to get the dollar continuing to benefit from this, and we're seeing South African inflation coming down in the meantime, we have a fundamental driver to the upside in US dollar ZAR, which is, again, a potentially explosive market in terms of Forex markets. It still has 15% upside into its annual upper bound this year. And we also have an inverse head and shoulders breaking out as we speak, this time in the daily time horizon. So let's jump back to the charts, and I want to show you the final chart that I think has potential explosive upside from right now. And that chart is potentially GameStop, GME. Now, interestingly, if I overlay this with nat gas as well, you can see in periods of inflation where we get nat gas running up, there is a correlation. You tend to see the meme stocks, as equities go high, the meme stocks kind of outperform. As nat gas comes crashing down and inflation with it, you start to see the meme stocks underperforming. And now what we're seeing is very much like when nat gas picked up in 2024 and we had that explosive move in GME. We're also once again starting to see GME break out of a major kind of basing pattern. And it's doing this, if I just move this higher than nat gas, you can see nat gas came down. We saw GameStop kind of coming down. And again, this is because of the link to inflation. When you get increased inflation, stocks tend to go up, and you get the more cyclical, the kind of more risk on stocks going up more. And then when you kind of get inflation coming down, you get, the Walmarts, and you get some of those XLV defensive stocks going up instead. So you can see here, we've based in GME, we've broken the major high. And if we take the prior low over here, you can see that this is a failure to make a low. And this kickstarts a potential third wave. Now notice as well, as we just had that bigger liquidation in the Russell, GME managed to just move sideways. So when you get the benchmark Russell liquidating for about 4 or 5%, and you get GME doing this, what do you think can happen to GME if the Russell starts to pick back up into all-time highs? It's going to unpin this kind of consolidation in GME, setting it up for a much bigger run. In my opinion, I think we're going to potentially go over 30, as long as there's no kind of unexpected bearish catalyst. And we could even go as high as 33 or 35 in GME before the year is out. And finally then, if we pull up the chart for seasonality in the S&P 500, you can see this confirms that we could potentially still have upside potential in GME. Why? Because seasonality shows that December, November, they tend to be good months as you get spending and consumption around Christmas. But it's January and February where you start to see the lowest returns. And this is why I think we could still see upside over the back end of this year, and we could mimic the January 2021 peak with a potential top in Q1 of 2025. So it looks like we're still in that melt up phase, that kind of inflationary phase for the time being. It looks like the dollar is set to outperform, and the South African rand is one that could very much underperform versus the US dollar into the back end of the year because of the differentials that we're starting to see in the inflation outlook. Nat gas is also breaking out and has the ability to be explosive to the upside. And even if you don't trade that, it's worth paying attention to, because this is exactly what happened in 2021 and what caused fear to come into the markets and for traders to switch their bullish equity bets to bearish equity bets, causing that Q1 peak in 2022. And finally, if seasonality tells us that December, we're likely to see increased consumption around the holiday period, and this can be supportive of stocks, it does suggest that any further upside in stocks is likely, in all probability, to hold into the back end of the year. And it's Q1, January, February of next year, we should be looking to with caution. So that is it from me for today, guys. As always, I hope you enjoyed today's video. And if you did, why not consider joining us in the GMT training room each day, where I look at the best markets, as well as sharing real-time setups that I'm personally looking at trading with members as part of our GMT training program. Don't forget, you can also get a 2-week free trial to the cutting-edge Hedge-Trading app used in today's video by heading over to www.hedge-.com. Access to the cutting-edge Hedge-platform is included with every GMT membership.